The nightmare scenario is here. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, a major retailer warns consumers are facing a financial nightmare. And you're not going to believe what shift in consumer habits these retailers are seeing and why it means the worst is yet to come, not just for consumers, but for the retailers as well. And is the government cooking the books? Well, stay tuned to the end of the show. I'm going to make the case of why I think they are. Now it's over to Bloomberg, where we picked today's story up with the headline: China's stocks test critical support levels as sell-off extends. And why do we keep focusing on China? Because they are the world's largest exporter. And if they are having problems, that means not only is the U.S. having problems, but the global economy is facing a downturn. In this case, we're seeing now the issue with the downturn hitting the Chinese stock market. And what's notable here is that U.S. investors believe, and they always believe, that stock prices not only will rise, they will always rise regardless of any type of condition the economy is in. And yet we always see the opposite. And right now, investors all over the world are piling into the U.S. equity market because they think we're immune to the next downturn. Well, I'm tight. I'm going to show you why we're not at all. The downtrend comes as global investors remain pessimistic on China's outlook, with its economy showing a fragile recovery and the real estate crisis continuing to worsen. Foreign outflows have persisted despite Beijing's attempts to stabilize sentiment. And this is one of the reasons, again, we look at why is the U.S. equity market rallying, as we can actually see hard evidence in the data that our economy is indeed slowing. Now, it may not be slowing as quickly as other major economies, but we still nonetheless are slowing down. And one of the simple reasons is investors from all other parts of the world are looking at their domestic economies, their domestic markets, and putting their faith in U.S. stocks. Meanwhile, Moody's Investor Services wide-ranging outlook downgrade across China's sovereign and corporate ratings has added to the headwinds investors are facing there. And this means the Hang Seng Index is testing a long-term trend line support. Now, you might be wondering, why would Bloomberg run such a chart like this? Why does it matter? What does it mean? Well, let me show you here, because I want you to also see just how desperate Beijing is starting to get, because now they're turning their attention onto the equity markets as well. But when we look at this chart, what you see with this trend line is where buyers have been at before. And one thing we notice is that when people invest in things, well, they generally don't like to lose money. So what happens is you see what's called a trend line drawn on this chart, suggesting that if indeed price breaks down below here, the people that bought at these prior levels will likely turn into sellers. The question the market's asking right now is, are these buyers going to come back in at this level? I'm going to make the case here shortly of why they're not likely to come back at all. The big reason is they don't have the money. Hong Kong's Hang Seng Index is approaching a long-term trend line that goes back to the 1998 Asian financial crisis. The line has offered support during the 2008 financial crisis, suggesting this is where buyers are willing to buy more of the Hang Seng at. And the benchmark was able to quickly rebound after breaching the threshold in October last year. The question remains is, will it hold this time? And this is where we're starting to look not just at the global economy markets, but we'll look at the U.S. markets as well. And that's when we get to what's going on with these retailers and say, wait a minute, can the U.S. equity market rally in the face of what consumers are facing in this nightmare scenario? Well, let's take a look first at, can stocks keep rallying no matter what happens with the U.S. economy? Well, the answer is no. And here we're looking at the net percentage of domestic banks tightening standards for commercial industrial loans to firms of all sizes against the Wilshire 5000 price index. Now, why are we looking at this chart? Because people believe that stocks just somehow magically can go up. That maybe if the Fed cuts rates a little bit, the stock prices just magically will jump higher. The reality of the situation is you need more money created in the economy to afford these higher prices. This is why when you see credit being constricted in a debt-based economy, and you see a reduction in the amount of money circulating in the economy, that asset prices eventually come down. And that's what this chart is telling us here, that because the Fed has inverted the yield and money curves, banks have now tightened lending standards, they're creating less money. The challenge is we haven't really eaten through all of that pandemic stimulus, and maybe now we have, but the issue, as I made before, and why I want to talk about China, is money's coming from overseas into the U.S. equity market. But look what eventually happens. As money dries up in the economy, and you see here, banks tightening lending standards, anytime that blue line's above the horizontal black line, what happens to the equity market? It eventually goes down. That happened in the global financial crisis as well. We saw it on the onset of the pandemic, which made sense, but now look what happened. The equity market starts to come down as banks are tightening standards, and then all of a sudden, we have this rally kicking off here as everyone believes that maybe this was the bottom of the bear market and everything's about to turn around. The reality is, as long as central bankers continue to keep the commercial banks from creating new money, it's only a matter of time. And one of the reasons we kind of see this late stage rally in the U.S. equity markets every time, it's all foreign flows coming here looking and hoping that the U.S. economy holds tight, but in reality, it won't. As China proposes cut to transaction fees on funds to boost the market. And I want you to see here how governments go from one extreme to another. First, the economy's too weak, so we ease. Then it's too hot, so we have to cool it off. Well, then we went too far, and we have to start easing again. And now Beijing is getting desperate, looking at its equity market and saying, wait a minute, if money keeps flowing out of here, well, that means the whole economy is going to come crashing down. We're not going to be able to get investors to buy into our companies, into our stocks. That's a big problem. They need desperately outside money flowing in all forms. And China's financial regulators proposed cutting the commission rate for public funds, the latest measure to spur more trading and bolster the market in the world's second biggest economy as it faces headwinds. And the China Securities Regulatory Commission is seeking public opinion on the proposal to reasonably reduce transaction fees and plans to strengthen supervision of the distribution of commissions for securities trading of public funds. Because the issue here, and I love this, is that the reason people aren't buying Chinese equities is because the commission's too high. And if you just simply lower it, well, suddenly everyone will think, wow, that's a great deal. I'll come in and buy stocks. The reality is people are looking at the Chinese economy. They're looking at the value of the yuan. They're looking at what Beijing's doing, the property markets, everything, and saying, you know what? This is not a good place to invest my money. And in fact, if I have an opportunity to get out of this country, I'm going to take my money out and go somewhere else. Right now, they're putting their faith in the U.S. equity market. The only question is, for how much longer? But let's take a look at why Goldman's top economist says a soft landing is coming, because that indeed is the narrative here that we want to show you, is the broad belief, and why everyone is investing in the U.S. is the belief that the Federal Reserve has engineered the impossible of a soft landing. But when we start to look at what these retailers are saying, and I don't have one major retailer, I have two that are providing evidence that there is a nightmare scenario now facing U.S. consumers, and in turn is going to face retailers. But one thing that matters here, even if the Chinese market goes down, you can still make money. It's just that easy. Let me show you how one of our recent trades, we show you on the show almost every day how easy it is to make money trading. Some of you said, Steve, I've never made money trading. And then I signed up for your reports and boom, it works. Here is a trade on wheat. This was taken on December 1st. We showed you, I'm going to show you right now in the reports just how easy it is to trade. That trade right now at 5.4%. Talking about beating the market here. Let's look back on November 28th. And we alert our subscribers a couple times a week to when they should be watching certain securities because they get to extreme positions. Now, our CTA Time Pro, it looks at the machine positioning. And then it does a historical overlay, which machines don't do. That's what gives us the edge. It was in this deep short position on November 28th. We said, wait till this thing comes off of it. Well, it did. on the 29th, which you could have put a trade in there. And you can see it coming off that short position as the machines were starting to buy back as price rally. But many of our successful traders, they wait. They have subscriptions to both our CTA and our Momentum Timer Pro. This one looks at the technical indicators, smooths them all out at a 1 daily buy count on December 1st. And that, my friends, turned into this 5.4% gain so far. And we still think there's room to run on that. And you can get both reports. There's links in the description below. And right now, for 3 people, there are 3 coupon codes. Get them before they're gone to get a free month of each. And wait till you see it'll change how you trade. And then you'll be a long-term subscriber. But let's go back to what's going on here with Goldman in this mythical soft landing. And I'm going to show you why. We're facing a hard landing scenario. And that all adds to the narrative of why would the government be willing to cook the books? That'll make perfect sense. You're right. The title of our annual Outlook report, which we published a couple weeks ago, is that the hard part's over. The reason why I think the hard part is over is that we have proof of concept that we can bring down inflation. Now, I want you to note the key word here, proof of concept. Now, why would they say proof of concept? Is simple, because we've never done this before. There's never in the history of the U.S. or world economy where any central banker has ever achieved a soft landing. So this could be, if it happens, the first. In reality, they don't exist at all. And that's why you see Goldman saying, hey, this is just a proof of concept, because we don't know, but they believe we can bring inflation down and rebalance the labor market without having to crush the economy and put the economy into a recession. And that's not true, because you want to bring inflation down, you bring demand down. Do you know what the easiest way to bring demand down is? Put people on the unemployment line. Works every time. And here's the evidence. You see the consumer price index, this in blue, on a year-over-year rate of change against continued claims. This is people who are on and have been on unemployment. And what do we know? That you put people on unemployment long enough, well, what happens? Inflation or demand comes down. That happened throughout the 70s each and every time. Even though inflation did spring back, you did put enough people out of work, and inflation and demand comes down. That reoccurred here again in the early 1990s as more people were on unemployment. Well, there went demand. You see that going into the dot-com bubble. It was just a simple case. There just wasn't enough money being created in the economy to support the labor market, put people on unemployment. You caused demand to come down. Again, it happened again during the global financial crisis, and it's starting to happen now again as we continue to see continuing claims rise and inflation fall. The difference is, this is what everyone believes. This is what these political elites and all these experts believe, and I don't subscribe to it. Maybe you do. Leave a note in the comment. Is they believe that at some point the change in the labor market is going to settle down, inflation will continue to drop, and then next year, you know, the economy will rebound and inflation will stay in check. It's not likely. Once you start to see a move higher in continued claims and people unable to get back in the workforce, it's only a matter of time before that data continues to rise. More people get on the unemployment line, and inflation comes crashing well below the Fed's target. And it's so quite important to think about what question you were asking. There are long lags in terms of the impact on inflation, which would suggest that, well, it's coming down even more. There are even some pretty long lags in terms of the impact in monetary policy on the level of GDP. But as a forecaster, what I care more about is the maximum impact on growth rate. And because I have a non-recession forecast, again, this is his opinion, and we've already gotten through the biggest hit from the tightening without the economy having entered recession. Now we're seeing some negative impulses. That's not going to worry me much because we've already survived the biggest hit. And yet what he's missing here is he talks about these lags, and the lags aren't really measurable. The issue is the lags occur because banks are constricting credit. The yield and money curves are still inverted. That hasn't changed. And so this guy at Goldman thinks we got through the worst. What I'm telling you is we're about to see from these retailers, the worst is yet to come. As Walmart CEO says, consumers may not be as resilient next year, even as deflation. Wait a minute, deflation starts to show. That's not a good sign. That means demand is crashing in a big way. Now, let's take a look at what Walmart says. And we got another retailer echoing some of the same sentiment. In an interview recently, we see the leader of the world's largest retailer said higher credit card balances And dwindling household bank accounts raised questions about how much consumers will spend, even after they showed more resilience than expected this year. That resilience was they were willing to draw down their savings. They started to believe in the soft landing narrative. They believed inflation was going to come down. They believe their wages are going to grow. And we're saying, look, you can't have it all, and you're not. If we had been talking last spring or at the beginning of last year, I expected more softness by the time of the year than we're actually experiencing, he added. Next year, well, that's a different story. In fact, Walmart's seeing deflation in some items, which is creating a new dynamic. In general merchandise, a category that includes electronics, toys, and other non-food items, prices have dropped about 5% compared with a year ago, and you can bet that's not fed into the CPI report just yet, but wait till it does. We've made the case as things come out of China. Remember, China exports deflation. It eventually gets into U.S. consumer prices. Not to be outdone, Dollar General warns of constrained consumer spending head into 2024, and our customer continues to tell us they're feeling significant pressure on their spending, which is supported by what we see in their behavior. And this is a big deal because Dollar General caters to some of the lowest social economic classes. So you would think that if their customers are having problems, that is a big warning sign. In fact, many people are now trading down to stores like Dollar General because they're running out of money too. In fact, that is the whole story here, is when banks constrict credit, less money is created in the economy, and eventually you start to see signs where people are running out. That's what's happened at Dollar General. Discount store operators have been struggling with a shift in shopper preferences for essentials, things they must have, over general merchandise, saying they'd like to have, while they face stiff competition from other retailers like Walmart. And Dollar General has been taking measures to, wait a minute, keep prices low on everyday staples, as well as offering discounts and promotions to clear excess stock. All those things sound like disinflation and deflation, because not only are consumers tapped out of money, we've noted they've drained their savings down in a big way. The next only question remains is, when do they hit the red line on their credit cards? Well, the data is suggesting they may be there now. As consumer credit expansion slowed dramatically in October, this from Zero Hedge, the latest data on consumer credit for October confirmed the slowdown seen in December as total debt increased by just $5.13 billion. This is a clear regime shift, lower from recent months when the monthly increase was in the $20 to $30 billion range and everybody was excited. But now it appears that the tightening from the banks is starting to actually impact consumers. And starting with the former in October, credit card balances rose by just $2.9 billion, with the exception of June's freak negative revolving credit print was the lowest increase since April of 2021. So notably, we're seeing that trend slow down again. And what that means is as banks tighten standards, again, it all comes back to the banks, and it all comes back to these inverted yield and money curves. When there's less credit being created by the banks and they tighten standards, well, they do it by putting limits. So they said, instead of raising your credit card limit, we're going to freeze it. Maybe we're going to lower it a little bit. You may remember during the global financial crisis, what we had is credit card companies. If you had any margin on your credit card, bam, you got a statement that says, well, no, your limit is now what you owe. And so what this does is it pushes pressures on consumers. We know they haven't kept up with inflation. And sure enough, when banks tighten lending standards, what eventually happens is revolving consumer credit, shown in red, goes down. You see that during the dot-com bubble, the global financial crisis, and now we're seeing that downward trend again. We see some one-off reports. This data series is rather noisy, but generally the trend is lower because now we're starting to face the question of when consumers are running out of money on their credit? Well, it appears now. But the question remains, the one big question is the government cooking the books, and why would they? Well, there's a big reason I want you to understand, is because if people believe things are better than they are, then they behave like it. The problem is, if they believe they're actually bad, well, they behave like that too. And can the government help convince people that maybe the labor market is strong and to go out and get a job, and that maybe they should keep spending because wages are going to keep going up? Sure they will. Let's take a look. As U.S. payrolls rose 199,000 in November, shocking, well, just about everybody. Unemployment rate falls to 3.7%, suggesting, of course, that means the Federal Reserve might have to continue hiking rates. Of course, we're going to show you why. The unemployment rate is meaningless, despite the fact that Powell continues to tell us it's all that matters. And non-farm payrolls rose by a seasonally adjusted 199,000 for the month, as the unemployment rate declined to 3.7%, and notably the labor force participation rate edged higher to 62.8, suggesting more people are coming back into the workforce at a time when more people are on unemployment. And that's not a good sign at all. And here we can see, does the unemployment rate matter in terms of Fed policy? Well, I've overlaid the federal funds rate. And if you're looking at this saying, well, gee, I don't see any correlation here, that's because there isn't any correlation between the two. The Fed just does what the Fed wants. As we made the case in a recent show, all that matters is a 2-year Treasury yield, nothing else. Average hourly earnings, a key inflation indicator, increased by 0.4%. This causing a little bit of a sell-off in the bond market today, and up 4% from a year ago. The monthly increase was slightly ahead of the estimate, but the yearly rate being in line. And all this matters now is total compensation, now for the second time since this big drawdown, is slightly above the rate of inflation. Now, does that mean it's going to hold very long? Well, the answer is it's unlikely to, because companies, if they're going to give people raises, well, that means they're going to take a hit on their earnings and their stock price. So unless demand over the holiday season comes back, which is what I believe this is, it's just a seasonal demand push here going into the end of the year to get workers, because we need them. Once that's over, I think we're going to see a marked shift in the labor market, and there's a reason why. Now, we've talked about, is the government cooking the books on this Bureau of Labor Statistics survey? Is that why we're at the BLS today? Well, it is, and there's a very good reason for it. And I'm not trying to specifically pick on the government. I'll let you do that. The issue here is they want people to believe things are better than they are. And there's an easy way. It's called revising history, because nobody cares about last month or the month before. Of course, it's been the case every month this year here from Zero Hedge. Previous month's data was revised lower, with September down by 35,000 and October remaining flat. Seems like the BLS is getting shy of these downward revisions, and we will see what happens in January if the December data is actually revised down. So expect today's quote-unquote beat to revise by a miss next month. Of course, as we know, it won't matter then, because again, nobody cares. That's why we do these revisions, because only people care about what is now and not what has been. And that is why what we're seeing in these retailers is telling us there's a major shift in consumer habits here. It has a dire consequences for the economy. Tells us the worst case scenario is indeed coming. We're going to have a recession, and the fact that total compensation edged slightly over inflation is absolutely meaningless when we take a look at how many people are still on unemployment and why that number is likely to continue to rise. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.